We just lived through a week that made no sense on the surface. Strong semiconductor evidence was sold repeatedly, while Adobe rose 5 to 6% for 4 straight sessions without earnings or company news.
One side fell regardless of good evidence, and one specific software name rose without a fresh catalyst. So the question was simple. Was price telling us something about the businesses, or were we watching someone else's forced order?
By Thursday, public reporting gave us a major missing piece and a different framework for reading the week.
Quick note. This is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
Welcome to the Working Thesis. Let us walk through the daily sequence leading up to July 29th to show you what that puzzle looked like. Adobe was up 6.1% on July 24th, up 5.62% on July 27th, up 4.81% on July 28th, and up another 5.72% on July 29th.
Meanwhile, the semiconductor index, the SOX, fell 4.4%, 2.05%, 4.8%, and 5.38% on those exact same days. Micron fell 6.99%, 2.25%, 8.85%, and 9.94%. The public narratives were everywhere. People blamed an AI bubble, China tensions, CapEx return on investment fears, and a massive rotation into software.
Those were plausible narratives, but price alone could not distinguish fundamental repricing from forced flow. The concentration suggested that something mechanical might also be operating beneath the surface.
Right. When moves are this concentrated without a clear catalyst, market structure deserves a place beside the fundamental story. The narratives explain part of the tape, but not necessarily the speed and specificity.
The inverse pattern made a forced unwind more plausible, even though broad rotation and fundamental concerns could still be operating at the same time.
Adobe rising by similar amounts while Micron and the semiconductor index fell day after day was unusually specific. It did not prove a mandate was being liquidated, but it was a clue that discretionary allocation alone might not explain the tape.
On July 30th, CNBC supplied a major missing piece. Situational Awareness, a fund founded by former OpenAI researcher Leopold Aschenbrenner, had grown to a reported peak size of $45 billion by early July and was facing liquidity pressure. Public first-quarter holdings included Nebius, SanDisk, Micron, and CoreWeave.
CNBC also named declining SK Hynix exposure and software shorts, specifically including Adobe, Bank of America, Goldman Sachs, and JPMorgan worked with the fund to meet margin requirements or reduce positions in an orderly way. They marketed a group of long and short holdings before the Thursday open.
And Citadel reached an agreement to buy the publicly traded assets. Now, the exact margin requirement, the total losses, the leverage used, and the purchase price or discount were all undisclosed. The situation was fluid, and we could not determine whether these sales fully satisfied the margin calls.
Exactly. And this brings us to how we need to think about greed and leverage. Think of investing as choosing a destination for a long journey. But leverage gives the lender an emergency brake and a deadline. When margin is called, the lender chooses where your trip ends.
That is a sobering way to frame it. You can have the right destination in mind, but the journey gets cut short.
Yes, a thesis can be entirely correct long-term, but extreme concentration and leverage can make it impossible to survive the path there. When we say greed, we are not making a moral attack. We simply mean that position size exceeded the ability to wait.
The July 30th and July 31st sessions left a visible fingerprint around that transfer. Adobe fell 5.9%, then rose 1.01%. The SOX jumped 8.5%, then stayed basically flat, up 0.07%.
And Micron rose 18.36% before falling 5.9%. 4 days of software buying and semiconductor selling reversed on the session when those holdings were marketed and transferred.
That is strong evidence that the fund was one important mechanical contributor to the unusual price action earlier in the week.
But it is not proof that the fund caused all the market action. Korean leveraged products, estimated negative gamma positioning, SOXL flows, macro shifts, and broader momentum trading may also have accelerated the moves.
The timing is still striking. The session when the holdings were marketed and transferred coincided with Adobe reversing and semiconductors rebounding.
That is strong evidence of a liquidity event. But other forces were present too. The transfer may have removed one large source of pressure and allowed the broader market structure to reset. It does not let us assign every tick to one fund.
Let me ask the natural question. The buyer had time and cash, while the seller had very little room to negotiate. Could someone have targeted this fund and pushed it toward a forced sale?
An outcome can certainly look engineered without any conspiracy actually existing. Distressed sales create massive information asymmetry. Prime brokers and potential buyers know the urgency of the situation. Other traders might infer the vulnerability and front-run the flows.
So, CNBC only noted that Citadel agreed to buy the public assets in what sounds like an ordinary distressed liquidity role, but the exact terms are unknown.
Correct. There is no evidence that Citadel caused these moves or engineered the blow-up. A buyer in that position can gain optionality and compensation for absorbing urgent risk, but being the winner of a distressed sale does not make it the culprit.
That makes logical sense, even if it feels unsatisfying to people caught in the crossfire. The seller needs time and cash. The buyer has both. That imbalance naturally favors the buyer.
And the exact price and discount were not disclosed. The safe conclusion is that Citadel provided liquidity to a distressed seller, not that it created the distress.
This entire episode leaves us with 3 major lessons for how we read the market. First, price is not always information. A chart driven by a forced seller looks identical to a chart reflecting fundamentally broken businesses.
Second is the dispersion clue. Adobe outran the broader software IGV index by roughly 18 percentage points in July. That specific outperformance versus the sector is a clue that something mechanical may be happening underneath.
And third, we have to admit our own uncertainty. We previously said the software rally was being funded by a broad rotation out of semiconductors. We observed the direction right, but we got the mechanism completely wrong.
We missed the mechanical driver. The durable rule is that if your position size can force an exit before your thesis can be tested, your lender controls your horizon.
That distinction changes how we analyze future dispersion. Relative strength can reflect conviction, but it can also reflect a crowded trade unwinding.
Exactly. It forces us to respect market plumbing as much as company balance sheets. You are no longer investing only in the thesis. You are also exposed to the path that gets you there.
We saw a closely related dynamic in South Korea, just in a different wrapper. Korean retail investors had heavily entered single-stock leveraged ETFs concentrated on Samsung and SK Hynix.
Then the margin rules changed. The cash requirement increased from 10 million to 30 million won, effective July 31st. Authorities apologized and restricted new products after the episode.
CNBC confirmed the price reversal. SK Hynix rose nearly 30% on July 31st, its best day on record. Samsung rose nearly 27%, also a record. Before that, SK Hynix had dropped roughly 27% across 3 sessions, with declines of 14.65%, 9.61%, and 5.64%.
The underlying memory business did not change that much in 96 hours. Reduced forced supply, combined with strong cloud evidence from Microsoft and Amazon, helps explain the reversal. There is never just one cause.
The common lesson here is that leverage converted a deep belief in the AI memory thesis into a forced timing mechanism. Greed outweighed fear, right up until the moment that fear was outsourced to the margin clerk.
It echoes the institutional unwind. Whether the account is institutional or retail, leverage makes the path matter. When the broker raises the requirement, conviction no longer controls the timing.
Let's look at the verified CNBC Friday, close to see where things finally settled. The S&P finished at 7,489.72, up 0.7%. The Nasdaq reached 25,373.85, up 1%. And the Dow closed at 52,485.03, up 0.53%.
Amazon jumped 15%, but Apple dropped over 7%. From the Wednesday close through Friday, the SOX gained 8.58% versus 2.42% for the IGV. But Friday's semiconductor gains faded a bit intraday.
Apple reported record revenue of $109.4 billion and EPS of $2.02. Greater China revenue was a bright spot, coming in at $18.82 billion, up 22.4%. But the guidance was the issue.
They guided revenue growth of 9 to 11% versus the roughly 12% expected. More importantly, gross margin is guiding down to 47 to 48% from the current 50.1%.
Tim Cook called the memory component shortage a 100-year flood on the call, underscoring the supply constraint.
Apple's reaction was its worst post-earnings decline in about 13 years, erasing roughly $460 billion in market value. The takeaway is that consumer demand is not the immediate problem. Margin and supply are.
When we zoom out to the July scorecard, the flat headline numbers hid sharp internal dispersion. From July 24th to July 31st, the S&P was up 1.05%, the Nasdaq up 1.59%, the IGV up 7.5%, and the SOXX down 4.2%.
Looking at the full month from June 30th to July 31st, the S&P was down just 0.13%, and the Nasdaq fell 3.2%. Underneath that, the IGV was up 4.39%, while the SOX fell 21.2%.
The individual names were even more dispersed. For July, Microsoft gained 24.58%, Adobe gained 22.14%, and Micron fell 28.7%.
That is the danger of looking only at the index level. The headline indices barely moved on the month, while the internal outcomes were dramatically different.
Broad averages smooth those differences. July was defined less by index direction than by dispersion between software, semiconductors, and individual crowded positions. And this was all happening against a very difficult macro backdrop. The 10-year yield ended near 4.75%, meaning long yields remained a constant valuation pressure on these highly valued tech names.
Meanwhile, the Bank of Japan held rates at 1% in an 8-to-1 vote. Hajime Takata wanted 1.25%. Leaving further rate risk on the table.
The sharp yen move and intervention speculation added another source of uncertainty for carry trades.
That is the broader risk. A leveraged book can face equity dispersion, higher long yields, and foreign exchange volatility at the same time. We cannot measure how much each channel affected this fund, but all of them reduce room for error.
So what happens after a large forced seller transfers the public assets? The immediate test is whether Friday's semiconductor fade continues into next week. Citadel is now a voluntary holder, but how it manages the block is unknown.
We also have a huge week of earnings ahead. AMD reports on August 4th, HubSpot on August 5th, Datadog, Cloudflare, Atlassian, and key uranium names on August 6th, followed by Applied Materials on August 13th.
The close leaves us with an open question. After this reported forced seller transferred the public assets, does AI infrastructure evidence regain control of the market, or was Thursday mostly a transfer day bounce?
It comes back to our central thesis. Remember why the investment existed? Then size it so that time can remain an ally. Fear can preserve optionality. Greed that removes time can destroy it.
The coming earnings will show whether the infrastructure narrative has operating evidence behind it once the forced flow distortion fades. That's the week. Thanks for joining us on The Working Thesis. That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.